Namaste, dear students. Hope you people are doing good. So, today I'm here with next problem number 2 in accounting for holding companies. So, which question has been asked in the year November-December 2007 question paper. So, let me read out the questions so that you will also get a clarity and copy the question. From the following information, you are required to prepare consolidated balance sheet of P Company Limited and its subsidiary Q Company Limited as on 31st March 2007. He has given the balance sheet. Liabilities P Company Limited, Q Company Limited. Assets P Company Limited and Q Company Limited are there. So in the liability side, take down share capital. So under share capital, equity shares of rupees 100 each. Under P Company Limited, 8 lakh rupees. Under Q Company Limited, 4 lakh rupees. Okay. Then reserves and surplus. Take down capital reserves P Company Limited 1,50,000, Q Company Limited nil. General reserves P Company Limited 1,40,000, Q Company Limited 1 lakh. Surplus P Company Limited 2,60,000 rupees, Q Company Limited 50,000 rupees. 50,000. Next we have secured loans P Company Limited 2 lakh rupees, Q Company Limited nil. Unsecured loans P Company Limited nil, Q Company Limited 1 lakh. Then we have provisions. Creditors rupees 1,50,000 P Company Limited, and for Q Company Limited it is 60,000 rupees. Bills payable rupees 1 lakh P Company Limited, rupees 40,000 Q Company Limited. P Company Limited total 18 lakh, Q Company Limited total 7,50,000 in the liability side. Let us move to the asset side now. In the assets, first item you have fixed assets. P Company Limited, goodwill 2 lakh P Company Limited and 50,000 Q Company Limited. Machinery 5 lakh P Company Limited, 2,50,000 in Q Company Limited. Buildings P Company Limited 2 lakh rupees, Q Company Limited 1 lakh rupees. Then we have investments. Under that 3,000 shares in Q Company 3,60,000 rupees P Company Limited amount column. After that write down other securities P Company Limited nil, Q Company Limited 60,000 rupees. Then write current assets and loans and advances. Under that write down stock 1,20,000 P Company Limited and 90,000 in Q Company Limited. Debtors 1,50,000 P Company Limited and 1 lakh in Q Company Limited. Bills receivables 1 lakh P Company Limited and 50,000 in Q Company Limited. Bank 1,70,000 P Company Limited, 50,000 Q Company Limited. So P Company Limited total 18 lakh, Q Company Limited total 7,50,000. So apart from this, they have given 3 adjustment. Adjustment number 1, bills payable of Q Company Limited includes rupees 30,000 due to P Company Limited. So bills payable of Q Company Limited includes a rupees 30,000 rupees of P Company Limited, which has been due. Adjustment number 2, sundry creditors of P Company Limited includes rupees 50,000 due to Q Company Limited. see, adjustment number 1 and adjustment number 2, we should reflect it as a mutual transfer. Okay, don't forget, we have to show it as a mutual transfer. Third point, on the date of purchase 1/4/2006 of rupees of 3,000 shares in Q Company Limited by P Company Limited. The balance sheet of Q Company Limited showed a general reserve of rupees 40,000 and surplus of rupees 20,000. So there was a general reserve rupees 40,000 and there was a surplus of rupees 20,000. So with this information we have to prepare a consolidated balance sheet. So without any further delay, let us start the consolidated balance sheet. So let us begin with the working note part. So dear students, let us start the solution. So that is number 2. Okay, so I'll mark it here, November December 2007 question paper. Okay, so solution we are doing, solutions. So always we should start with first working note, that is step 1. Step 1, calculation of shares of holding and minority ratio. Okay, so under this, first we have to take the value of share capital. Total value of share capital. Total value of share capital of, yes, subsidiary company. So how much? See, this is total value of share capital of subsidiary company, 4 lakh. So 100 rupees each. So if you divide 4 lakh divided by 100, 4,000 you will get. Clear? So here you have to observe one more thing, the shares held in subsidiary company as well. See, here in this it says share capital is 4 lakh divided by 100, 4,000. So here number of shares in subsidiary company is 3,000. 3,000 shares. So 4,000 minus 3,000 is 1,000 is minority. Understood? So let us calculate that. So total share capital how much? 4 lakh divided by face value. So face value divided by face value is 100. So how much you will get? So you are going to get 4,000. 4 lakh divided by 100. So out of 4,000, so holding company share is 3,000. So 4,000 minus 3,000 left out is 1,000. So what is common? 000, cancel it. So ratio is 3:1. Okay, so this is holding company, this side, and this side is minority. Okay, so I believe you are clear till this point. So next, step 2, calculation of minority interest. So step 2, calculation of minority interest. Calculation of minority interest. So take down one by one now. Cost of shares held by minority. So what is the cost of shares held by minority? Number of shares held by minority is 1,000, right? So 1,000 shares, face value is 100. So 1,000 into 100, how much? 1 lakh rupees you got. 1 lakh rupees. Add total reserves. Add total reserves. So what is the reserves they have given? Reserves, general reserve. Don't take capital reserve, general reserve. So general reserve of Q Company Limited 1 lakh. So 1 lakh into, what is the ratio, minority ratio? 1 by 4, correct? So 3 plus 1 is 4, minority 1 divided by 4, majority 3 divided by 4. So now I am calculating minority interest, so 1 divided by 4. So that comes to 25,000. Calculate, you will get 25,000. So after that, you should add P&L. P&L account. So P&L account, how much they have given checkout? So that is Q Company Limited. Q Company Limited. So how much they have given? Q Company Limited P&L account. Surplus, he has given it as a surplus in this problem. Remember, surplus is nothing but profit. Okay, so to make you clear, I'll write it here. So in this problem, he has given it as a surplus. Surplus is nothing but profit. So Q Company Limited is 50,000 rupees. So 50,000 into 1 divided by 4. So that comes to 12,500. That comes to 12,500. So now total it. So how much you got? 1,25,000, 1,37,500. So total it and keep it. This is, we call it as minority interest. Minority interest. Clear? Fine. So let us move to the next step. Step 3. Step 3. So in step 3, what are we going to calculate? Calculation of cost of control. Calculation of cost of control. Calculation of cost of control. So now here you have to check. You have to check investment of holding company. Investment of holding company. Investment of holding company. So how much it is? Usually you will get in the asset side. So that is 3,60,000 rupees. 3,60,000 rupees. Okay. So next, less face value. So how much is the face value? So number of shares held is 3,000. So face value of the share is 100. So 3,000 into 100 is 3 lakh. So how much excess has been paid? 60,000 rupees. Whatever excess paid, we consider that as a goodwill, correct? So this is going to be a goodwill then. Goodwill. Okay. So we are done with the third step. Next we are going to identify step 4. So that is calculation of pre and post acquisition of profit of holding company. Profit of holding company. So take one by one now. Pre-incorporation. So how much profit we had in pre-incorporation surplus? 50,000. Correct? 50,000 rupees. minus. So in the adjustment, he said clearly, bills payable of Q Company Limited includes rupees 30,000 due to P Company Limited, that is mutual transfer. Sundry creditors of P Company Limited includes rupees 50,000 due to Q Company Limited. This is also mutual transfer. Then he says on the date of purchase on 1/4/2006 of 3,000 shares in Q Company Limited by P Company Limited. So this is also number of shares he has given with the date. Then this adjustment is not, I think, came in your problem. See, you just copy this adjustment, okay, to the problem. So it might have been missed out. The balance sheet of Q Company Limited showed a general reserve of rupees 40,000 and a surplus of rupees 20,000. So this you should add it to your problem. After 3 adjustment, fourth adjustment is the balance sheet of Q Company Limited showed a general reserve of rupees 40,000 and a surplus of rupees 20,000. You copy this adjustment to your problem, to this problem only, okay. So what is the surplus? General is 40,000 and surplus is 20,000. So 20,000 surplus he has given, okay. So 20,000 surplus he has given, okay. So you take that 20,000 for pre-incorporation. So 20,000 into 3 divided by 4. 20,000 into 3 divided by 4. So you will get 15,000 rupees. So this we transfer to capital reserve account. Okay. So then post incorporation he has given how much? Surplus 50,000, right? So 50,000 minus this pre-incorporation 20,000 minus it. So the left out you will get 30,000 into, in this you take 3 divided by 4. So that comes to 3 by 4, 22,500 need transfer to P&L account. Transfer to P&L account. So 30,000 into 3 divided by 4, 22,500 P&L account. Okay. So next is reserve. The same way, this is for profits or surplus we did. So now we are doing it for reserves. So we are doing this for reserves. So what is the total reserves he has given? So in the pre-incorporation general reserve, you don't take capital reserve. So general reserve 1 lakh rupees, correct. So 1 lakh rupees he has given. So 1 lakh rupees out of this 1 lakh. So pre-incorporation we take. Pre-incorporation how much he has given? That is in the adjustment he said. 40,000, right? So 40,000 into 3 by 4 directly. So that comes to 30,000. This you need to transfer to CR account, capital reserve account, okay. So then post incorporation. So how much you got? 60,000, right? So 60,000 into 3 divided by 4. Why this is 60,000? Because he has given 1 lakh rupees in the post incorporation. So that is in the liability side of Q company, 1 lakh rupees minus adjustment value 40,000, pre-incorporation value 40,000. So 1 lakh minus 40,000 is 60. 60,000 divided by into 3 by 4. So how much you will get? Calculate 60,000 into 3 divided by 4, 45,000. So this 45,000 need to be transferred to profit. So clear till this point? Yes. So let us prepare the consolidated balance sheet then. Why to make delay? consolidated balance sheet. P Company Limited. Okay, so this is going to be a particulars. This is going to be a rupees column. Okay, so now let us take one by one. Let us consider one by one. Okay, so in the first head, what all you have to write? First main is always share capital, correct? So first main share capital. So you need to consider only P Company share capital. So P Company share capital, how much they have given? 8 lakh rupees. So directly I am taking 8 lakh rupees. Okay. So then he has given reserves and surplus. We have to take in the second main. Reserves and surplus. Reserves and surplus. Correct. So under reserves and surplus, first let us take capital reserves. Capital reserves. So how much they have given capital reserves? 1,50,000 rupees for P Company Limited plus 1,50,000 plus in Q Company there is no any capital reserve, nil. But in step 4 we have identified for CR. CR is nothing but capital reserve. Step 4, out of profit 15,000 rupees. I have written next to it as a CR, plus out of reserve 30,000, again I have written it as a CR there. Okay, so now add this, so that comes to 1,95,000 rupees. So I am writing this directly, 1,95,000 rupees. Okay, this is out of profit and this is out of reserves. So both is in step 4. Okay, so after that we have to go for general reserves now. So check out how much general reserves they have given. General reserves they have given 1,40,000 rupees, that is P Company Limited. So I am taking directly 1,40,000 rupees. P Company Limited general reserve. The other we have distributed. Clear? So after that we have to take profits. We have to take profits. So take profits, that is nothing but surplus in this problem. In this problem he has given it as a surplus. So Q Company Limited, how much? 2,60,000. So Q Company Limited 2,60,000 plus, so go to the step 4, their profit I have written it as a P&L, so that is 22,500 plus under reserve I have written 45,000, that is profit, 45,000. So add these 3 and put it to outer column. 2,60,000 plus 22,500 plus 45,000. So put together 3,27,500. 3,27,500. Okay. So after that we have to take non-current liabilities. Non-current liabilities. So in this problem he says secured loan. So secured loan is considered as non-current liability. So third item is non-current liabilities. So under this you write only secured loan is left. So secured loans. So how much secured loan is? 2 lakh rupees. So I'm writing it directly 2 lakh. Then after that only one item is there. Then after that we have to go for current liabilities. Fourth one, current liabilities. So current liabilities, what are all he has given as a current liabilities? Check out the problem. Creditors, bills payable, and provisions. That is current liabilities, correct? So unsecured loan also we should take here only. Unsecured loans. So unsecured loans how much? 1 lakh. So that I have taken. So next under that we have to take current liabilities. So he only has given as a current liability. So let us take one by one. So current liabilities, under that we have to take creditors first. So write down as a creditors. So what is the value of creditors? 1,50,000 rupees. So that is P Company Limited, 1,50,000 plus Q Company Limited. How much? 60,000, right? 60,000 rupees. Okay. So 1,50,000 is P Company, 60,000 is Q Company. So minus 50,000 rupees, which has been given in the adjustment. Adjustment number 2. Sundry creditors of P Company Limited includes rupees 50,000 due to Q Company Limited. So that I am deducting. So if you add and deduct 2,10,000 minus 50, so that comes to 1,60,000 rupees. So 1,60,000 rupees creditors. Okay. So then let us go for bills payable. Bills payable. So how much he has given bills payable? So that is 1 lakh rupees. P Company 1 lakh plus Q Company 40,000. Q Company 40,000. So adjustment number 1. Bills payable of Q Company Limited includes rupees 30,000 due to P Company Limited. So minus 30,000. Minus 30,000. So this, what we are doing, this is called mutual transfer. Both the places it will get deducted. Okay. So 1,40,000 plus 1 lakh plus 40, 1,40,000 minus 30, 1,10,000 is outer column. So 1,10,000 is outer column. So after all this you have to take minority interest. Actually minority interest we need to take under I forgotten that we need to take under current liabilities. Okay, minority interest. So this is step number 2, right? Step 2. So step 2, whatever the amount you have got, that you need to take here. 1,37,500. So I think that's all I have done with all the things. So now I am doing the total of liabilities. So take one by one. 8 lakh plus 1,95,000 plus 1,40,000 plus 3,27,500. 3,27,500 plus 2 lakh plus 1 lakh plus 1,60,000 plus 1,10,000 plus 1,37,500. So that becomes 21,70,000. 21,70,000 rupees I got it. So now let us go for asset part. Okay. So under asset part, so we are going fifth step we are going now. So fifth step, non-current assets. Non-current assets. So that is nothing but fixed assets. So check out what are all non-current assets he has given. The first part is non-current assets. Fixed assets he only said. Okay, so first item he has given there as goodwill. So let us take in that order only. So first I am taking goodwill. So P Company Limited 2 lakh plus Q Company Limited 50,000 plus in the adjustment we have identified that is 60,000 rupees. That is 60,000. This you will get in step number 3. Calculation of cost of control. So 2 lakh 50 plus 60, 3 lakh 10,000. Add it and write it. 3 lakh 10,000 rupees. So after goodwill he has given machinery. So I am going to take machinery. What is the value of machinery? 5 lakh. 5 lakh plus Q Company 2 lakh 50,000. 2 lakh 50,000 rupees. So add it, put together 7 lakh 50,000 rupees. Done. So then he has given buildings. So I am taking buildings directly. Buildings. So what is the value of buildings? 2 lakh. So 2 lakh plus 1 lakh. 2 lakh plus 1 lakh, put together it is 3 lakh. So there is an item called other securities. There is an item called other securities. So that is nothing but investment. Okay. So we will take other securities. Other securities. So how much they have given? Other securities 1,20,000 plus, sorry, other securities is only 60,000. Only 60,000 I am taking. Okay, other securities. Okay, so next he has given current liabilities. So next we are moving to current assets. I am sorry. 4, 5, 6th one. 6th main, current assets. So under current assets, let us record one by one. Stock he has given 1,20,000, that is P Company, plus Q Company is 90,000. So add it and put it to outer column, 2,10,000 rupees. So then we have debtors. Debtors value is 1,50,000 plus 1 lakh minus, there is a mutual transfer. How much? In creditors we did 50,000, right? So minus 50,000. Mutual transfer. So whether it is, if it is reflected to creditors, it must reflect it to debtors as well. So 2,50,000 minus 50,000 is 2 lakh. Okay. So then we have bills receivables. Bills receivables. So how much bills receivables it is? He has given 1 lakh plus 50,000. 1 lakh plus 50,000 Q Company Limited minus mutual transfer he has given 30,000. Mutual transfer 30,000. So 1,50,000 minus 30, 1,20,000 rupees. 1,20,000 rupees mutual transfer. Then we have bank balance. Bank balance we have 1,70,000 plus 50,000. That's all. So that is 2,20,000. So I have taken all the items, I believe. So I have not left anything. So let me see the total of this. So that is check out 3,10,000 plus 7,50,000 plus 3 lakh plus 60,000 plus 2,10,000 plus 2 lakh plus 1,20,000 plus 2,20,000. So put together 21,70,000. 21,70,000. 21,70,000. So both the total got tallied. So we are done this problem. So it got tallied. So we'll meet you in the next session. Till then, take care. See you soon. Bye bye. Stay safe. Stay home. Take care of yourself and your family members. I'll be right back with one more problem very soon. Till then, take care. Bye bye.